Are you retired or nearing retirement? Wondering if your portfolio is in good shape or not? I get it. We look at the news, and for every person talking about stocks, there's one that says buy, and there's another one that says sell, and it's bloody confusing, and often clickbait. But what if you knew about a select list of investments to avoid when nearing retirement, or when in retirement? Would that make you feel a little better? In this video, I'm not telling you what to buy. But no, in this video, I'm going to cover 16 investments to avoid, and I'm going to divide it into two sections. The first 9 are investment categories, and the remainder are some individual stocks to avoid when nearing retirement or when in retirement. But before I begin, this video is brought to you by Sure Dividend. Sure Dividend helps investors find high-quality income securities for their retirement and financial freedom portfolios. And the Sure Dividend newsletter analyzes their top 10 high-quality dividend growth stocks each and every month. Stay tuned, and I'll be giving you a coupon code for a nice discount. All right, so investors who are getting close to retirement have different needs than investors with many years left in the workforce. Retiring means losing the regular paycheck from work, and as a result, replacing that income is super important. There's many investments that appeal to retirement investors, such as purchasing quality dividend stocks like Dividend Kings, stocks that raise their dividend for at least each of the last 50 years. And by the way, here's a video I did about Dividend Kings that I think you'll like. But there's also many investments that retirement investors should stay away from. Retirement investors should avoid the following 16 investments. Number 1 on the list is cash. Cash is king, right? Well-known phrase. But when it comes to retirement investing, cash is hardly king. Cash should be avoided by retirement investors because it earns no return. This is in contrast to bonds, which pay interest, or stocks that pay dividends, or even a rental property that'll give you monthly rents. Cash earns no interest, and as a result, cash loses value over time due to inflation. And while retirees have a number of challenges to pay for expenses without a regular paycheck, keeping a great deal of cash on the sidelines is not the best idea. Ideally, retirees can generate enough income from their investments in combination with other sources of income, such as Social Security, so that they don't need to hold a large amount in cash. Number 2 on the list of investments retirees should avoid is high-yield bonds. Sometimes they're referred to as junk bonds. High-yield bonds are fixed income securities issued by companies with sub-investment grade credit ratings. With interest rates near historic lows, fixed income yields have plunged over the last several years. As an example, the 10-year Treasury yields just 1.3% right now. And with inflation running significantly above this level, retirees will see their purchasing power fade away with these low-yielding bonds. And because of this, it's natural that high-yield bonds are more appealing due to their higher amount of income. But be careful. Higher yield means higher risk. And risk is something that needs to be managed in retirement. Bonds with below investment grade credit ratings have a higher likelihood of default. Number 3 on the list of investments to avoid when in retirement are cryptocurrencies. Bitcoin, Ethereum, and others are popping up daily. They're all the rage these days. And the massive rise in the value of Bitcoin and other cryptocurrencies over the past few years is enticing for any investor. And cryptocurrency gets a lot of coverage in the financial media. I mean, if an investment shoots up 1,000% in a year, that's gonna get news. But retirees need to remember that volatility is a two-way street. Let me give you an example. In April, Bitcoin was trading a little over $63,000, its all-time high. And today it's only around 30,000, but that's more than a 50% drop. And folks, retirees nearing retirement, ask yourselves, what would a 50% drop in an investment mean? And to make matters worse, Bitcoin doesn't pay interest or dividends, meaning investors will not generate income from their investment. Number 4 on the list of investments to avoid in retirement are oil and gas royalty trusts. These are niche securities within the stock market. Oil and gas royalty trusts are companies that own oil and gas producing properties. Investors receive distributions depending on how much income the trusts generate from these properties. Some well-known oil and gas royalty trusts include BP Prudhoe Bay and Permian Bay Royalty Trust. As with any group, not all royalty trusts are bad investments, but the risks are high across the board because royalty trusts are essentially a bet on underlying commodity prices. Investors also have to face the prospect that reserves might decline faster than the trust initially anticipated. If oil and gas prices fall, share prices of the royalty trusts collapse, and their distributions decline, often to zero, as occurred in 2020 during the coronavirus pandemic. Number 5 on the list of investments to avoid in retirement are mortgage REITs, also referred to as REITs. Look, REITs are a great way for retirees to earn higher levels of investment income, and many REITs have strong yields of 4% or more. And some folks nearing retirement, or even retirees, might be tempted to buy mortgage REITs. It's a subset of the asset class that typically offers higher yields. Indeed, many REITs have yields in excess of 10%. But in many cases, sky-high yields are an indication of elevated risks, and mortgage REITs are no different. Mortgage REITs are extremely complex business models that are not easy to understand, making them relatively poor choices for most retirees. In addition, mortgage REITs' share prices and their dividend payouts can swing wildly based on the changes in the yield curve. Number 6 on the list, we have gold. Every few years or so, gold gets lots of attention in the media because the price of gold has risen over a certain period of time. But for retirees interested in generating sustainable income from their investments, gold should be avoided. Gold doesn't pay any dividends or interest, which is why it's not attractive for many retirees. Now, some gold stocks, like Barrick Gold, do pay dividends, but their dividend track records are highly inconsistent. Many gold stocks have cut their dividends when precious metals decline. Number 7 on the list of investments to avoid when in retirement are momentum stocks. Now, what are momentum stocks? Momentum stocks are those that have captured investors' attention, most often due to their rapid rise in their share price. This causes other investors to jump in, perhaps because of a fear of missing out, which can push the share prices even higher. But in many cases, momentum stocks fall back down to earth, as their underlying fundamentals just don't justify the rallying share price. Momentum stocks that have gotten a lot of attention in the media recently include GameStop and AMC. In all cases, their share prices skyrocketed in a relatively short period of time. But retirees should resist the urge to buy these momentum stocks, as they can be highly volatile and almost never pay dividends. Number 8 on the list of investments to avoid in retirement are microcap stocks. Now, market cap is simply the current share price multiplied by the number of shares outstanding. And large cap stocks have market caps of above 10 billion, while small cap stocks have market caps below 2 billion, and with mid caps are somewhere in between these ranges. The smallest group of stocks is known as microcaps. These are stocks with market caps below $100 million. Microcaps are very small businesses, and their stocks generally have low liquidity, and many are in questionable financial condition. As a result, retirees should stick with mid-caps and large caps. Number 9 on the list of investments to avoid in retirement are stocks with too much debt. Debt is a big concern for income investors such as retirees. Stocks with bloated balance sheets and too much debt are at risk of cutting or suspending their dividends during recessions. Profits may decline substantially when the economy enters a downturn. And like your credit card or your mortgage, corporate debt still needs to be repaid. Stocks with excessive debt have high interest expenses that may force them to cut their dividends. And this is of particular concern when it comes to high-yield master limited partnerships, many of which have leverage ratios above 5x. So folks, these past 9 investment categories pretty much sum up what should be avoided when nearing retirement or when in retirement. Now I'm going to start talking about individual stocks that investors might want to avoid in retirement. But before I get to number 10 on the list, remember that promo code I mentioned earlier for the Sure Dividend newsletter? Well, because you're watching this video, you can go ahead and use my coupon code FIM41OFF to lock in savings of $41 a year and get instant access to the newsletter with a 7-day free trial. I also went ahead and left you a link in the description below. Okay, so number 10 on the list of investments to avoid in retirement is Tesla, a blue chip stock with a market cap above $600 billion. But just because Tesla is a mega cap, it doesn't imply a higher level of safety. Tesla still struggles with maintaining consistent profitability. The company reported a net loss of $862 million in 2019 and $976 million in 2018. Now, yes, in 2020, Tesla generated $721 million of profit in 2020, but on a per share basis, that's only 64 cents. And for a stock that's trading over $600, that seems really low. With such a low level of profits, Tesla has never paid a dividend and may never pay a dividend. And while shareholders have earned massive returns by owning Tesla, whether retirees should invest today is a different question. Number 11 on the list of investments to avoid in retirement is Netflix, a major tech stock and a streaming giant. And who hasn't heard of Netflix? The company has grown its revenue at an incredible pace this past decade, and it has come to dominate the streaming industry. And while Netflix is a top growth stock and benefits from the ongoing cord-cutting trend, retirees should avoid it simply due to its high volatility and lack of a dividend. Number 12 on the list of investments to avoid in retirement is USA Compression Partners. It's an example of an MLP that's flashing warning signs that the high distribution may not be sustainable. USAC is one of the largest independent providers of gas compression services to the oil and gas industry, with annual revenues of $668 million in 2020. The partnership is active in several shale projects throughout the United States, and they focus primarily on infrastructure applications, including centralized high-volume natural gas gathering systems and processing facilities. Unfortunately, the company has struggled to recover from the pandemic, which has squeezed its financial position. First quarter revenue fell 12% year over year, while its distribution coverage declined to just 1.03x, meaning that the current payout is barely covered by distributable cash flow. And if the distributable cash flow declines further, the payout may be reduced. Number 13 on the list of investments to avoid in retirement is Great Elm Capital, a business development company, otherwise known as a BDC. These stocks are popular among income investors because they generally have high dividend yields. But many BDCs are highly risky due to their eroding fundamentals and lack of dividend safety. And Great Elm Capital is an example of a BDC that should be avoided. Great Elm Capital is a BDC that specializes in loan and mezzanine middle market investments. Their net investment income decreased by 6% in the first quarter, a warning sign as the company can barely afford to maintain their current dividend. Furthermore, it's seen its book value erode rapidly since going public in 2016. And while their shares currently yield over 12%, investors should be wary of extreme high-yielding BDCs like Great Elm. Number 14 on the list of investments to avoid in retirement is GLAXOSMITHKLINE. International stocks are a great way for investors to gain diversification by a geographic market, but not all international stocks are attractive for income investors. Retirees should avoid GLAXOSMITHKLINE in particular because the company has had a great deal of difficulty generating growth in recent years. GLAXOSMITHKLINE reaffirmed its expectations that its earnings per share will decline by a high single-digit percentage in 2021 due to a low expected growth in pharmaceuticals and vaccines. As a result, the company is likely to have a very high dividend payout ratio, which could jeopardize its ability to maintain the dividend. And there's so many better healthcare stocks for retirees, such as the dividend king Johnson & Johnson. Number 15 on the list of investments to avoid in retirement is ANHEUSER-BUSCH, the largest beer company in the world. The company produces, markets, and sells over 500 different beer brands around the world. Major brands include Budweiser, Stella Artois, and Corona, generating nearly $50 billion in annual revenue. But retirees typically want stable dividends and steady dividend growth over time, and ANHEUSER-BUSCH is not an attractive stock for either. ANHEUSER-BUSCH cut its dividends significantly over the past few years in an attempt to fix its balance sheet, which had become full with debt after multiple huge acquisitions. The company has stated that deleveraging is a priority for 2021 and beyond until a leverage ratio of 2x is attained. But ANHEUSER-BUSCH remains far from this goal with a current leverage ratio of 4.8x. And with a very low dividend yield near 1% and a low likelihood of dividend growth, retirees should just avoid this stock. Last but not least on the list of investments to avoid in retirement might surprise you. Hey, it's Amazon. Okay, yes. They've been one of the best growth stocks in the entire market over the past decade. But for retirees who might want consistent portfolio income, Amazon is not an appealing stock. Yes, Amazon continues to grow its revenue at a high rate, and the company has been quite profitable. In the first quarter 2021, Amazon increased its revenue 44% to $108.5 billion, and earnings per share tripled over the same year. And yet, Amazon does not pay a dividend because the company needs to continue to reinvest as much cash flow as possible back into the business for growth. Retirees who like mega-cap tech stocks could generate dividend income from others like Apple, Microsoft, or Cisco. Wow, guys, this was quite the list. Do you agree with any of this? What do you think we should be avoiding in retirement? I love hearing from you, so let me know in the comments below. In the meantime, thank you so much for watching, and I will see you in another video. Bye.